Okay, tax class, folks. Two or three of you, well, a couple of you always online. Hillary's here sometime, not today. Clayton's here about all the time. Don't see him today. I think Cole had a death in his family. Don't see Cole. And Jonathan's not here without Cole. So I need a broom with a wig on it to stand up in the room for attendance. But since there's no one here except me and hopefully you sometime, we're going to look at some solutions for problems for Chapter 9. These are current solutions, so we'll spend about an hour probably on these solutions and bring out some points probably in the chapter. It's a good chapter. It's related to itemized deductions. It has these employee business expenses and business and non-business. And it also mentions the deferred comp, which will help when you get out there in the working world. I was just talking to Michael. He's one of our accounting majors, and he's a good student. And he loved preparing taxes for VITA. Now, Michael graduates in December, and we had no one interested this year. Philip and I would have taken you to Beckley, and you're going to sign up as a West Virginia junior CPA. Well, Michael did that a couple of years ago, and he went to Charleston to a job fair. He interviewed with Brown and Edwards and application with some other firm. Well, Michael is graduating in December, and he goes to work. He goes to work up in Marietta, Ohio, which is on the West Virginia-Ohio border. A river separates, and I guess you have a Marietta, Ohio, and a Marietta, West Virginia. But anyway, he has taken a job with them, and his salary, only thing I asked him, was it over 40? And it is over 40,000 a year. That's not bad for a new graduate without a CPA to start out with. Like will be in their tax department, and he loves taxes. They will expect him someday to pass the CPA. If he takes a review course, they'll pay for it, and he'll learn on the job. He'll get his experience, and he will be a CPA. But anyway, that's a success story of one of our students just about ready to graduate. We have other success stories, and but that's the one I'm sharing at this moment. Okay, to try to separate some of these expenses, we'll go straight down to the problems, and wherever they start here, must be way down here at number 41 or something or another. 44, really. All right, problem 44. Mike's AGI is 120 before any of the above expenses are deducted. None of the expenses listed above are reimbursed by Mike's employer. He has no other miscellaneous itemized deduction and does not use the standard deduction. All right, now, if he took 2% of 120,000, you know what 2% is of 120,000. All right. He does get to take his automobile expenses used in the line of work, 50% of entertainment, 100% of travel, 50% of meals, and his professional dues. That's $6,000. All right. The moving expenses are deductible for AGI. You wouldn't want to put that as an itemized deduction because itemized deduction is from AGI. All right. Thus, Mike's AGI is $116,000 after he deducts that for moving. Okay, and then 2% of $116,000 looks like it's $23.20 from the 6, so he can take $36.8 in miscellaneous itemized deduction. So that's not bad. He'll also take the moving. Now that'll be from. And of course, the moving expense is 4, so keep that in mind. Okay, number 45. Travel and entertainment. Monique is a self-employed manufacturing rep, an independent contractor who solicits business for numerous clients and receives a commission based on sales. Now, she's independently employed. She solicits business. She had this airfare, business meals, local transportation, commuting expenses, and local entertainment of customers. Now, we know commuting expenses, $1,000 is not deductible. But we see that the travel, the business meals, the transportation, the entertainment are total deductible expenses. Now, commuting expenses are not deductible. For the local transportation, Monique can compute the deductible expenses under either actual or the mileage. These methods are covered in detail later in the chapter. Now, because she is self-employed, the answer would be the same for 2018, except entertainment expenses are not deductible. Now, each of these items for 17-18 are classified as a 4. You do not take them as an itemized deduction. You take them off on her Schedule C. All right, she'll have a Schedule C, take them off. C, if Monique is an employee, then these employment-related expenses are deductible from AGI as a miscellaneous itemized deduction, requiring to take out 2%. All right, I hope you watch this video because I may take some of these questions and put them on the next test. Okay, doke. Number 46, unreimbursed employee expenses. Murray also pays $1,000 investment counseling fees and $500 tax return preparation. Now, what is the total amount of Murray's deductible expenses for 2017 or deductible expenses classified for or from? She got airfare, taxi fare, meals, laundry, lodging, business meals, and entertainment. All right. Now, looking at number 46, she gets to take the airfare. She gets to take the taxi, 50% of the meals, all the laundry, all the lodging, 50% of business meals, 50% of entertainment, all of the investment counseling fees, tax preparation fees. So this is the amount that she can take as a miscellaneous itemized deduction. Take out the 2% and she come out $3,050. And of course, these are from. Okay, now travel expenses. There was one topic, employee business expenses. Now travel. Merlin's business executive who lives and works in Cleveland accesses a temporary out-of-town assignment in Atlanta for a period of 10 months. She leaves her husband and children in Cleveland and rents an apartment in Atlanta during the 10-month period. Merlin incurred the following expenses, none of which were reimbursed. Now, airfare to and from, airfare for weekend trips to visit her family, apartment rent, meals in Atlanta, entertainment. And you know you cannot take airfares for weekend trips to visit your family. So we're going to leave that $8,000 out to start with. And all right, we got the airfare, which is $8,000 plus $800. Wait a minute. They may be giving her that. Well, they're not deductible anyway. None of these travel expenses are deductible for 2018. In 2017, since Merlin is a temporary assignment of less than 1 year, her tax home is still considered to be Cleveland, while in Atlanta. Thus, all of her expenses are considered travel expenses, and she can deduct the following. They are going to let her take all the airfare. The apartment rent, 50% of the meals, 50% of the entertainment. So that's for 2017. Are each of these expenditures classified as for or from? Of course, they're from. All right. C part, 21,650 deductible, computed as follows: 2% of the 120,000 deducted from the 2450 leaves you 21,650. The airfare for weekend trips, apartment rent, and meals would be personal non-deductible expenses. A portion of the airfare might qualify as a moving expense. All right, I thought the airfare for weekend trips would be personal. Let me read what D has to say. Do the tax consequences change if her assignment is for a period of more than 1 year? Now, less than a year, everything is hunky-dory up here in A part. More than a year, she loses the weekend trips and the apartment rent. All right. That's travel. We're going to skip over to number 49, employment-related expense and reimbursement. Maxine incurs the following employee-related business expenses. Professional dues, those are deductible. Airfare and lodging, okay. Local transportation for employment-related business activities, that's deductible. Customer entertainment, that's deductible. Okay, without reading the question on number 49, in 2017, since the reimbursement is less than the expenses, an allocation is required. All right, now you're going to get a $3,000 reimbursement. Is prorated to the various expenses. Now you got to do that because of the meals. All right, you add up all of the fees here, 5,000. All right, 1,000. Let's see. Well, I've got to read the rest of the question now. After making an adequate accounting of the expenses, she receives a $3,000 reimbursement. Her AGI is 60. She has other miscellaneous itemized deductions of 1,000 and does not use the standard. What amount of the expenses is deductible? Maxine for 2017. How much would your answer change if the tax year were 2018 rather than 17? All right. Now look at the difference here. In 2018, the $3,000 reimbursement would not be included in her gross income since the expenses were equal to or greater than the reimbursement. The reimbursement was made pursuant to an accounting plan. The excess employee business expenses of $1,000 are not deductible in 2018. Entertainment expenses are not allowed 2018. That's the year that we're going to be worried about. All right, but 2016, 17, she gets to take 60% of all of these expenses. That's for AGI. That adds up to the 3,000. See, 1,000 over 3,000. What is 1/3? Let's see. Well, we have to figure out this 60%. 60% of 1,000, 60% of 12,2, and 60% of 1, 60% of 1. That adds up to be the 3. The other 40% is from AGI as an itemized deduction. Now, that changed from 17 to 18. So let's try one more, number 50. Michelle is an employee who must use her personal automobile for employment-related trips. She drives her car 60% for business and incurs the following expenses: gas and oil, repairs, depreciation, insurance, parking, $22,500. She drives her car a total of 40,000 miles, 24 business. You'd have to multiply that with 53.5. What amount is deductible before the 2% floor if Michelle uses the standard mileage rate? All right, 24,000 miles times 53.5 cents, 12,840 plus parking. All right, minus reimbursed, she got 40 cents a mile. So she's got a deductible $36.40 on the 2106 form, other itemized deduction. Under the actual method, she had totaled up everything to be, let's see, standard mileage, she got 13,240. But here she got 13,660. Still minus the 9,600. So what's better, 4,060 or 3,640? You know the answer. C part. Although taxpayers are permitted to change from one method to another, there are specific requirements must be met. So you can change. A change from the actual method to the mileage is only permitted if the taxpayer uses straight line depreciation when you did your actual expenses. So in 2018, no transportation expenses are deductible. Employee business expenses are not deductible. So that was done away with. Thanks to the new tax code, I guess thanks to Donald Trump on that one. I thought it was a good deduction. All right, so 51 is about the same, automobile expenses. Now 52, let's get over to entertainment. Which of the expenditures listed above are deductible by milk? How would your answer change if it was 2018? Okay, we pay dues to the Chamber of Commerce, business lunches, entertainment, country club dues, blah, blah. So let's look at number 52. You should have done these even problems. All right, dues are deductible. Entertainment, 50% is deductible. Entertainment of clients, 750 is deductible. That's 50%. Now, the business meals are not deductible because bona fide business discussions must be conducted. So I gotta get some light on here. All right, 2018. Milt would be allowed a deduction of $1,000 for dues to the local Chamber of Commerce. That's it. Most entertainment deductions are done away with for 2018. All right, we're going down to 54. We should have worked on this one. She's an employee of the Cooper Company and incurs significant employment-related expenses. During the year, she incurred the following expense in connection with her job: airfare, lodging, meals, entertainment of customers. Determine the amount of a deductible expense if the tax year were 2017 and 2018. But once again, let's try to get this clear. Number 54. Since Cooper Company maintains an accountable plan and the reimbursement is equal to expenses, she will not report the reimbursement nor deduct the expenses. Cooper Company may deduct the expenses. All right, then reimbursement is less than the expenses, so a portion of expenses is prorated is required. The reimbursement is equal to 70% of the expenses. All right, so you will reimburse 70%. So now that part, if it's on your W-2, you take it out of AGI. Somewhere you take it out, even if it's under other, put a minus, or put it on the 2106 as a minus. And here, that is from AGI, and that will go down as a miscellaneous itemized deduction. This is 50% of the excess, 30% of the entertainment, and you're only going to take 50% of that. All right, miscellaneous itemized deduction. Okay, if this were not on a W-2, you wouldn't take it out for. If it's on a W-2, you take it out. Now, 2018, since to receive reimbursement pursuant to an accountable plan, she would not include the reimbursement in her gross income and would not deduct it. That makes sense. Now, her deduction would be $82.50. Cooper's companies would be $82.50. Since the reimbursement is less than the expenses, the reimbursement is not taxable and the expenses are not deductible. But Cooper gets to take out $57.75. Okay, the taxpayer would be required to return the excess of the reimbursement. In this case, if she was given too much. So that brings up another point or two. Okay, moving expenses, 55. It's the only one we have on moving expenses, and this is also a review of moving expenses. Only direct moving expenses are deductible. Now, automobile, 17 cents a mile. Moving van, $39.70. Temporary storage fee for less than 30 days. So total deductible expenses are $46.40. No deduction for meals on route. Used to be the points paid to acquire the new residence should qualify as interest expense, not as an itemized. The moving expenses are deductible for AGI on the front of the 1040 and use that 3903. Now, $46.40 of the reimbursement is used to offset the deductible moving expenses. The excess reimbursement amount is included in Michael's income. if you wanted to include, now I'm sure a lot of people don't. The company gives you $6,000, you only spend five. You're supposed to report the other thousand's income, even if it's under other income. So that's the only thing you have on moving expense. Now, education expense, 56. All right. In 2017, any deduction for a trade or business is deductible as a miscellaneous itemized deduction. For 2018, education expenses would not be deductible because miscellaneous itemized deductions are not deductible. So these were done away with in 2018. But if you're in 2017, this first part, law school tuition and books for an IRS agent who wants a law degree. That's a new trade or business, not deductible. B part, continuing professional accounting education. Yes. MBA education expenses total $25,000 for a business executive of a major corporation. Yes, that's related to work. Tuition and books acquired for graduate education class required under state law for a school teacher. Yes. Bar review course for a recent law school graduate. No. I hate that they've hurt education expense the way they have. But we're going to look at number 57. Anna has three possibilities of tax saving for the education in 2017, but nothing in 2018. And that's what we're looking at. So let's see what it says. That's number 57. Anna works for a CPA firm as a secretary and earns $27,000 a year. About 5 years earlier, she has completed 70 credits at State University. To increase her career potential, she decided to enroll at the local university. All right. She wants to be a CPA. During 17, she incurred the following: tuition fees, books. What are Anna's options as to the deductibility of the above expense for 17? And what would your answer be for 18? So looking at that, do it as a tax credit. We'll study this later, so she can definitely take the American Opportunity Credit, okay? 2018, here's one. Deductible as a trade expense. She could do that to improve her job. And I don't see what the answer is for 18. We'll try to look at another one or two to get that straight later. Okay, office and home. First one is number 58. Office and home, we had real estate taxes and mortgage and insurance, depreciation, repairs, and maintenance. Nancy uses her den as an office, 10% of the total floor space of her home. She prepares bills and keeps records. Now, her den, 10%. So she's got real estate taxes and mortgage interest. That's $7,000. Percent of home use is 10%. That's $700. Now, other office expenses, insurance, repairs, depreciation, 10% of that. That's $1,200. So office and home, deduct. All right, direct expenses, painting and window blinds, and then the 1,200 makes 2,400. Only the office used exclusively for business qualifies for office and home. The den is not allowed because it is not used 100% for tax purposes. So that is one rule in the chapter. Nancy's home office deduction is limited to gross income less regular business expenses and home office expenses. Since her net income before home office was $40,000, no limitation applies. Thus, the full amount of $2,600 is deductible as for. Now she's filling out a Schedule C now. So take that on a Schedule C 100%. And the rest of those deductions can be itemized deductions. Now, whatever question B is, which of the expenditures, let's see, would your answer to Part A change if her net income from consulting were only $2,500? Sure, it would change. Home office expenses exceed the gross income. They cannot. Gross income. So you take the mortgage first and the home office expenses and depreciation, that leaves zero. Now, one part of the chapter we've not spent a lot of time with, and it's a good part of the chapter, and it is IRAs, and it is profit sharing, and all of you will hopefully be into that someday. Okay, let's go straight to 60, I guess. Pat is a participant in a qualified plan. She retires on January at age 63 and receives pension payments beginning in January per month. Pat contributed $30,000 to the pension plan on a pre-tax basis, and the number of anticipated payments based on Pat's age of 63 years at 260. What gross income will Pat recognize in 2018? Okay. Now, this is just doing a little bit of calculating here. All right. Investment in the contract's 30. She gets 260 payments. So 30,000 over 260 would be, she'd get to exclude 115 per month. The excluded amount for the year is 115 times 12. So the amount received is 12,000. And the amount excluded is $1,384. Since the pension contributions were made on an after-tax basis, all right, she was already taxed on her income. Right here, you get to exclude it because you're not going to be taxed again on the same money. Now, up here, she was not taxed on any of her deposits. She was not taxed on the income before she donated. So the whole $12,000 will be taxed when she takes it out. Like my retirement here at Bluefield State, it comes out before taxes. I'm not taxed on it. And that whole amount will be taxable when I receive it, like a part. Now, my community college retirement, I did invest in it after taxes. And state of Virginia does exclude a little bit per year. All right, she'll put the difference in her income from pension payment plan. I want us to look at number 62, IRAs. I want you to take a minute, read 62, and jot down your answers. I'll give you about 3 minutes. I'll take some calculators down to the office. Okay, you've had time to read this. All right, Jamal, who is single and age 30, established a traditional IRA and contributes $5,500 to the account. His adjusted gross income is $69,000 and $58 and $19. He is an active participant in an employer-sponsored plan. What amount is deductible? And what year is it deductible? He may deduct $2,200 for the tax year 18, as the contribution was made by the due date, and that's by April 15th. The 63,000 ceiling is exceeded by 6,000. So 60% of the 6,000 is not deductible. Jamal could elect to treat the IRA contribution as made for 2019. Since Jamal's AGI is only 58 in 2019 and his income is less than the floor, he would be eligible to deduct the full $5,500 in 2019. Now that's if you have a qualified plan. Now I do want you to know this whole $5,500 is deducted in 18 and 19 or 19, or if you want to deposit it twice that amount, if he had not had a qualified plan. The deduction is for AGI because you have a place on the front of your 1040 to take it off. Now C part was what I answered. How would your answer be if Jamal were not an active participant? That's what I just told you that would be deductible. All right, so let's look at 63. Phil is 30, is married, and files a joint return. On February, Phil establishes a traditional IRA for himself and a spouse. He's got up to April 15th to do that in. $11,000. He can deduct it all, probably. We'll see. $5,500 for himself and $5,500 for wife. His expenses, his spouse only earned $4,000 for a part-time job, and their combined AGI is 75. Neither Phil or his spouse is an active participant. So what amount of the contribution is deductible? the full 11,000, 5,500 each. That's called a spousal IRA for her. All right, B part, to what year does the contribution apply? 2018. C part, how is it treated? It's for AGI on front of the tax form. D part, how would your answer to Part A change if Phil and his spouse were active participants in a profit sharing plan? No change, since the joint AGI does not exceed 101,000. E, if a portion of the contribution is non-deductible in Part 1, D, is it possible for Phil to make a deduction and non-deductible contribution in the same year? Yes. Non-deductible contributions are permitted to the extent an individual is eligible to make the deductible contribution. However, the IRA deduction may not exceed $5,500. All right, F part. She's eligible to make $5,500 contribution to an IRA for tax year 2018, even though Phil is covered under an employee spouse plan and their AGI is less than 189. Now, these limits are given to you in the book, but you can do a spousal IRA. So these items are all good to know. IRAs. Okay. I want you to look at number 54 for Thursday and 65. 64 is the Roth IRA. 65 is an educational savings account. I want you to look at 66, that House bill, and 68, stock options. And we then will be finished with this chapter. So hopefully Clayton, you and Jonathan and Cole and Hillary can make it to class on Thursday. It is harder for me with no students in class. So please read chapter 9 again. Please work your homework. Please look at these problems. And I'll see you on Thursday. Hopefully, see you. Get out and vote.